Welcome, everyone. This is Tim Kelly from Breakthrough Insurance Group and the Simplicity Group. Thank you for joining us today to roll out our newest and most innovative proprietary product from Oceanview, the Topsider Fixed Indexed Annuity. A few logistical items before we get started. Everyone is muted so we can keep down the background noise, but we encourage you to ask questions by typing them into the Q&A box. We'll spend some time at the end of the webinar answering all of those questions. Also, there is a handout that is in your handout box as well. You can download that. It's a PDF. It's the product specs for the Topsider FIA. Thank you. So without further ado, let's jump right in and talk about this new and innovative proprietary product. Our agenda for today, we'll do an introduction to Topsider. We'll talk a lot today about the gain control option, which is really the differentiator in the marketplace for this product. We'll give you the current rates. We'll give you a little bit about Oceanview and ourselves, and then we're going to give you a call to action at the end, so please stick around until the end to see that. We got together with Oceanview a while ago and decided to partner on this product. We created this new indexed annuity, which is exclusively being distributed by Big and Simplicity. So what is the Topsider FIA? It offers principal protection just like other indexed annuities available in the marketplace. So there's no downside potential here, but it does offer enhanced growth potential through this gain control option. By incorporating that gain control option within the S&P 500 crediting strategy, this empowers your clients to adapt their retirement savings approach based on their changing needs and market conditions. So just in general, there's more upside potential than other FIAs in the marketplace, and it's very flexible depending on how your clients' needs change and what's happening in the markets. Excuse me. So just a couple of basics, the product specs. There's 5, 7, and 10-year durations in this product. The issue ages go up to almost 85, actually goes up to 89 for the 5-year duration. 10% free withdrawal after the first year. We have the differentiator, again, the gain control option, which I'm going to get into in great detail in a couple of minutes. There's a typical terminal illness waiver. If you're diagnosed with less than a year to live, all those surrender charges are waived. And a nursing home confinement waiver. Once you're in a nursing home for 90 days, it will waive all surrender charges and MVA inside the product as well. So that's just some basics on the Topsider specs. Let's talk about the index options, the different buckets where you can allocate your clients' money. The first one is the one I really want you to focus on. This is where you're going to put your clients' money to take as much advantage of this product as you possibly can. We're going to recommend that you put all of the money into this first bucket, the S&P 500 daily risk control 10% excess return. That's the index. It's an annual point-to-point with a participation rate. And inside of that, you've got the gain control option strategy. The second bucket is the S&P 500 annual point-to-point with a cap. That's a typical offering inside of an FIA. And then the third bucket is the fixed rate bucket. The one thing I want you to notice is that in the first crediting strategy, it is a participation rate. It is not a cap, it's a participation rate. And if you look at historical returns, participation rates generally perform better than a cap because there's no cap on those. The other thing I'd just like you to notice is that in the small type at the bottom, there is a maximum participation rate with this index of 300%. That will make more sense later as I get into the details of this strategy, but just kind of keep that note in the back of your mind for now. 300% maximum participation rate. So the index itself, the S&P 500 daily risk control 10%. This targets 10% volatility. Now that's different than most volatility control indexes in the marketplace today. Most of them target 5 or 7%. So this is going to have higher upside potential because it's allowing for that higher volatility. Again, let's just keep in mind, we're looking for that upside potential in this product to really take advantage of those market gains. So two things to note at this point. One is it's a participation rate. It's not a cap. And secondly, 10% volatility target, not 5 or 7. We're going to see the 10% historically perform better than the 5 or 7. So more upside potential in this investment. This is a very simple index. It puts the money inside the S&P 500 and some in cash. When the markets get more volatile, it's going to put more into cash. When they get less volatile, it's going to put more in the S&P 500. So very simple index. It controls the volatility by putting a balance into the S&P 500 and cash, and again, targeting that 10%, so higher upside potential here. Now, let's start digging into what differentiates this product from anything else in the marketplace, the gain control option. This allows your clients to increase their participation rate percentage by applying a portion of their index credit to purchase a higher rate for the upcoming contract year. Now, what does that mean? Let me just give you a very simple example. Let's say your client earns 10% in the current year. They can keep, let's say, 5% of that 10 and apply it to their earnings and use the other 5% to buy up the participation rate for the next year. Well, you might ask, how do we know if we should do that or not? That's what I'm going to tell you with some shocking statistics in just a couple of minutes, so stay tuned for that. This feature allows the clients to maximize their potential returns over time without risking their existing account value. A little bit more about the gain control option and their benefits. It enhances the growth potential. So by using the annual gains to increase participation rates, clients can seize opportunities presented by traditional market cycles to potentially maximize returns over time. So how can we predict if the market will go up? That's what we're talking about with these traditional market cycles. I'm going to show you that in a second. So you've got a couple of options inside the gain control option to dictate how much of your earnings you're going to use and keep, and how much you're going to use to buy up the participation rate for the next year. So the default is 50%, which means that you're going to keep 50% of your earnings and you're going to use the other 50% to increase the participation rate for the next year. So that's kind of your set it and forget it. You don't ever have to do anything with that. You can just let it ride and never change that. However, you and your clients have the flexibility to change that annually. You have the flexibility to choose from 0, 50, or 75% increases in the participation rate. So year to year, you can get together with your client and say, hey, based on what happened this past year, what do we want to do next year? Do we want to keep all of our earnings? Say that's your 0% option. Do we want to keep 50% and use the other 50 to bump up the participation rate next year? Or do you want to keep 25% and use 75% to bump up the participation rate next year even more? So here's a quick example. With the 50%, let's say you earned 10%, you'd be keeping 5 and using 5 to buy up the par rate. With the 75%, same 10% earnings, you'd be keeping 2.5 and using 7.5% of your interest earnings to bump up the participation rate. So I know that's a lot of numbers on a screen, but we're going to dig deeper into these details. So just keep watching, please, so you fully understand how this works and how it can really benefit your clients and supercharge their earnings more so than any other indexed annuity in the marketplace. So here's the automatic setting. Again, 50% of your gain is automatically carried over to increase your participation rate for the second year, unless you specify otherwise before your contract anniversary. Now here's the annual selection. This is where you can do 0, keep it at 50, or select 75, increase. These decisions need to be made before any interest is credited for the contract year. So you would get together with your clients a couple of weeks before their contract anniversary, go through kind of how the year went and say, what do we want to do next year? If you want to keep it at 50%, you don't have to do anything. But if you want to keep all of your earnings or use 75% to bump up the par rate next year, you simply fill out a little form, send it into Oceanview, and they'll make the change for that upcoming year. So that has to be done before the end of the year, before those interest credits are put into the contract. So let's take a quick look at a shocking statistic that's really going to change how you think about the S&P 500 and how you think about the markets overall, that's going to really help you and your clients to decide what to do with this product. Now, here's some numbers that when I first saw them, I just couldn't believe what I was seeing, that we could predict market cycles based on some historical data. So since 1948, so we've got over 75 years of data here. This is a really good amount of data to make this fairly predictable. The S&P 500 has shown a robust recovery pattern. So following 16 market downturns, 94% of the time, 2 or more consecutive years of positive growth followed. So think about that for a second. If the S&P 500 goes down, 94% of the time you had at least 2 years of consecutive growth after that downturn. Now let's take a little bit of look at the chart on the right here, and I'll take you through this a little bit to make sure you understand it. So what we have here is the 16 downturns on the bottom. That's the red. So we start in 1948, we go through 2024. We've got 16 downturns here. Now, the large majority of them are single year downturns. We can see that here and here, et cetera. In the mid 70s, we actually had 2 down years in a row in the S&P 500. And then in the early 2000s, 2000, 2001, 2002, we actually had 3 years down in a row. But other than that, they were all single years. You can see many more up years over the last 75. Now, if we know that 94% of the time we had 2 or more years of growth after a down year, I wanted to find which year was the one where it did not do that. And I found that right, let's see, in the early 1960s. You can see it right here. In 1960, it went down. Then in 61, it went up. And then in 62, it went down again. But other than that, 94% of the time, you see after a downturn, it goes up for at least 2 years. Okay, 94% of the time. And here's another number that just blew me away. 67% of the time, it went up for 3 years or more after a downturn. 67% of the time. That is the large majority of the time. We know after a downturn, it's going to go up for 3 or more years. You've seen some incredible periods of time in history where the S&P 500 just has gone up for 5, 6, 7, 8 years in a row. You can see that here in the 80s. And then again, you can see it here in the late 90s. And then again, 2000, looks like 2009 through 2015, just 5, 6, 7, 8 years in a row where it goes up after a downturn. So when I look at this, I say, how do we take advantage of this information? We know after a downturn, 94% of the time it's going up for 2 or more years, 67% of the time it's going up for 3 or more years. How do we take advantage of this? And this is what Topsider does for you. It allows you to take some of your earnings and increase your participation rate when you know that the markets are likely to go up. We know now by looking at this data when they're likely to go up. We have that information, so let's take advantage of it inside the Topsider product. Now let's look at exactly how that works and how we can do that so that you can counsel or advise your clients on what to do inside of this product. So let's just say we're using the 50% gain control option, the set it and forget it. You never have to change it. We're going to do 50% every single year. What does that mean? That means we're taking 50% of our earnings and we're keeping them. And the other 50% we're going to use to buy up the participation rate in the next year. So currently, the participation rate in this product, the current rate is 100%. I'll show you all the rates in a second, but currently it's paying 100%. So whatever the S&P 500 does in that year, that's what you're getting credited. So we start out at 100% in year one, and the index returns 7.26 in year one. So we get credited 7.26 because we get 100% of that. We take half of that because we've got 50% set in the gain control option. 3.63 is half of the 7.26, and we apply that to the account value. So we're keeping 3.63% of the money, and we're going to credit our interest account with that. The other 3.63 we're going to use to buy up the participation rate in the next year. That increases the participation rate from 100 to 174%. So for the next year, our participation rate is actually going to go up to 174%. As a general guideline, it will take about 4% to get a buy up of 100% in the participation rate. So what I'm saying is if this number was 4%, the amount going to the gain control option, this new participation rate would be about 200%. So it costs about 4% right now to buy up another 100% in the participation rate. So here we are in year 2 with 174% participation rate. Now the market goes down. So we get 0 credit, right? Because the market went down. You don't lose money in an indexed annuity. You just get a 0 rate of return. And then the participation rate goes back down to 100% when the market goes down. So now we start the next year at 100%. In year 3, the index does 6.12. So we get 6.12 because the participation rate is 100%. So we take half of that and keep it. We take the other half and buy up the participation rate to 163. Now this is what we've been waiting for, okay? This is using the gain control option to maximize earnings. Look at these numbers. In year 4, we now have 163 participation rate. The index returns 27.73%. So the S&P 500 volatility control 10% has a great year, 27% rate of return, but we get 163% of that. So we actually earn 45% inside of our annuity. 45%, what a year. So we take 33% of that and keep it. We use almost 12% to buy up the participation rate. Now we earn so much money that it's not going to split it 50-50 here, because remember earlier I said the maximum participation rate is 300%. That's the highest it can go. So it calculates how much you need to get it up to that max. And it's a little under 12% in this case to buy it up all the way to 300%. So you use 12% to buy it up to the max, and you keep 33% here for the total of 45. Now, so that's really what you're trying to get to. Nowhere else in the marketplace, in the industry, can you do this to get 45% like that by bumping up the participation rate. Understanding, again, remember, after a down year in the S&P 500, which we saw in year 2, there's a 94% chance that it's going to go up 2 years in a row, and 67% that it's going to go up 3 years in a row. So we nail it right here by using those earnings in year 3 to bump up the par rate to 163, and then catch it on a great year and get 45% in earnings. So now year 5 goes down. The S&P 500 goes down, nothing credited there. We go down to 100%. And in year 6, the index goes up by 15. So we split that again, 50-50. We grow our participation rate to 256. In the next year, we earn 2.86, but our par rate is 256. So we actually get credited 256% of the 2.86, which is 7.31. We split it again to buy the participation rate up to 174. Now we do it again in year 8. Look at this. The index goes up by 17%, but we got 174% par rate. That gives us a credit of 30%. Okay, so there's where we nailed it again in year 8. And in year 4, 45%, year 8, 30%. So I hope that's helpful to kind of show how this works. We're going to talk a little bit more about this in a minute to give you a little bit of a better idea of how this performs historically. But this is really what we're trying to accomplish. Can you imagine telling your clients that they got a 45% credit in their account with 0 downside risk? So you provided them with a 45% growth in 1 year with 0 downside risk, and then 30% in year 8 with no downside risk. That's great potential and a great story for your clients. So I went back and I looked at our illustration software just to give you some expectations of how this might perform. So, you know, in an indexed annuity illustration, generally you're going to see them look at the last 20 years, and then they're going to take the least favorable 10-year period, the most recent 10-year period, and the most favorable 10-year period. So I wanted to show you that with the 50% option first and then the 75% option second. So the least favorable 10 years over the last 20, with the 50% gain control option, it earned 5.9% annually. That's the worst case that it's done over the in the 10-year periods. Worst case was 5.9% you would have earned. The most recent 10 years is 7.55. The most favorable 10 years is 13.34. So just to set it and forget it, 50% option, you're likely to see something in that 6% to 13% range. So that's some really good numbers for an indexed annuity. Now with the 75% option, it's even better. That means that you keep 25% of your earnings and you use 75% of your earnings to increase that participation rate in the next year. So the worst 10 years is 6.29, the most recent 10 years, 8.43, and the best 10 years is 14.5. So about a point higher than the 50% option. So again, you're about 6% on the low end, 14.5 on the high end. I just wanted to set your expectations a little bit. That's what you're going to see in the hypothetical numbers on the illustrations. Here's a pro tip. If you really want to supercharge your earnings, use the 0% option, which means you take all of the earnings and keep them all. You don't buy up any participation rate in the next year if your earnings are over 20% for that year. So when you, what I'm telling you is that we went back and we analyzed all of this data for the S&P 500, and we had a higher rate of return overall if when the earnings were over 20%, we kept all of them. We didn't use any of that to buy up the participation rate in the future year. So I'm going to take you back a couple of slides here and show you where this makes sense. So this credit column where the client earned more than 20%, what I'm saying is in those years, keep all of the earnings. So remember year 4 where you were getting credited 45%? The index gained 27, but you had 163% par rate, so you got credited 45%. What I'm saying is in those types of years, keep that whole 45% and don't use any money to buy up the participation rate. So here you can see we used 11, almost 12% of that money to buy up the participation rate for the next year, and that year was a down year. So that 12% was effectively lost when you could have kept that. So you, in these years where you get more than 20%, keep all of that. You can see it again here in year 8 where you earn 30%, keep all 30. Again, you see the market go down the next year again, so you could have kept all of this 30% instead of using almost 11 to buy up the participation rate. So that's a little pro tip for you as a way to really supercharge your earnings. And we know that the 75% has outperformed the 50%. So we would recommend using that 75%. But if your earnings are over 20%, keep them all. So that's a little pro tip for you as a way to really help your clients grow their money. Here's the current rates. You've got the 5, the 7, and the 10-year products, right? So the participation rate in this index you're going to want to use. You've got 100% participation rate for all 3 durations currently. If you want to just do the typical S&P 500 point to point with a cap, got 8.5, 8 3/4, and 9. I will say to you that if that's the index that you're looking for, you probably wouldn't want to use this product. There's higher caps and other products that we can help you with. We've got all of those products and can help you with that if you're just looking for a simple cap rate. And then you have the fixed rate bucket down here. 3%, 3%, and 3.5. These are today's rates as of January 29th of 2025. If you're watching this recording at a later date, you'll always want to check with us to see what the current rates are. So a little bit about Oceanview. Based in Denver, Colorado, licensed in 47 states. So this product is not available in New York, Connecticut, or Vermont. It is available in the other 47 states. Oceanview is rated A by AM Best. And they have about 10 billion in total assets. You see some of their financials over here. What about us? What about simplicity? So we have 1,100 employees doing nothing but focusing on helping you to grow your insurance business. So we have 70 sales offices across the nation. 115 of us are business owners. We have 350 marketers, 100 plus sales support professionals, 3 national operations centers on one tech platform. Those operations centers are in Arizona, Minnesota, and Texas. Again, 1,100 employees all over the country. Last year, we did 500 million of life insurance sales, 11 billion of annuity sales. We also do long-term care and disability insurance. We do business with over 60 insurance companies to help you find the best one for your client. And we support 55 different financial institutions, meaning broker dealers and banks. Here's the real value proposition. We're really talking to you today about the Topsider product, but where we can really add value to your business is we have a 60-person marketing team dedicated to helping you close more sales. We will connect you with a marketing representative here that you will get to know very well, and that will help you build out your own personal integrated multi-channel marketing strategy that is focused on helping you close more sales. Well, how's that start? That starts with lead generation. We will help you to fill up your sales funnel with a consistent flow of new prospects. We do that through our proprietary systems and technology. We have turnkey marketing workshops. We will fill up those workshops for you with new prospects. In fact, we have one turnkey workshop called The Truth About Annuities that would work great for attracting new prospects to this Topsider product. We'll hold your hand through that entire workshop process, show you exactly how to do that, when to send out the invitations, how to get people in the door, how to follow up with them. We do all of that, hold your hand through the entire process. We did over 2,000 workshops last year with our advisors. We have it down to a science. We've done so many of these. We know exactly what works and what doesn't work. And we can walk you through that entire process. We do client referral events with you. We help you with social media content. If you want to do paid ads to attract prospects, even broadcast media like radio and TV, teach you how to email nurture those prospects until they become new clients. We will coach you through that first appointment process. We will actually teach you how to sell. We have a day-and-a-half in-person advanced sales training that we will teach you exactly how to connect with your clients through storytelling, enabling you to help your clients to want them to do business with you. They are going to be calling you for appointments. You won't be chasing them. So we have many of those scheduled for the rest of the year. They fill up really fast. We only take about 100 advisors in each of those advanced sales training meetings. so they fill up fast. So that may be something that you're interested in. That will help you sell everything. It will help you to grow your AUM. If you do manage money for people, it will help you to sell more financial plans if you're doing that. And of course, it will also help you to sell more insurance products like annuities and life insurance. We will help you through our proprietary technology to prepare for your appointments and to close those appointments and to increase those conversion rates as much as possible. Again, helping you to grow your revenue and the value of your business overall. Again, 1,100 employees totally focused on helping you grow your business. Now, a couple of disclaimers, just gotta show you those. I hope you can read really, really fast. There's all the disclaimers. Now what? What are the next steps? What's the call to action? You should email me at tim.kelly@simplicitygroup.com to get contracted to sell Topsider. Again, this is an exclusive product that only we are distributing, and we would love to get you guys contracted and get you started with Topsider. So I'm going to leave that up on the screen as I look at our questions, and I can answer some of those questions now. I see a few of those have come in. So one of the questions was, has this been back tested? So that question comes from Richard. Richard, yes, in the hypothetical illustrations, we will show you again what's happened over, the most favorable, least favorable, the most recent 10-year periods, et cetera, to show you what that looks like. Historically, of course, no one can predict future results. But we show you all of those hypotheticals, historical numbers, so you know what you might expect from the Topsider products, whether you're using the 50% gain control option or the 75%, or even if you're taking everything over the 20% earnings and keeping that and not using anything to buy up the future year participation rate. So hypothetically, we illustrate that in the illustration software to give you some good brackets, some good guidelines for what you might expect. Okay, well, it looks like those are the only questions we have at this point in time. So again, please simply email me at tim.kelly@simplicitygroup.com and we will get you out any additional information you need on Topsider and also get you started on contracting. Thank you very much for joining us again today, and I look forward to speaking with you soon. Have a great day, everybody.